Hello, everyone, and welcome back to another episode of the Wright podcast. In this podcast episode, I will be taking you through business cycles, systematic investment plans, how to invest, and everything in between. I'm your host, Sonam Srivastava, and I have the privilege of having one of the most special guests here with me, Rajesh Jayaraman. With more than 20 years of experience in banking and financial services and a deep understanding of product management, Mr. Rajesh Jayaram has been a cornerstone of Nippon India Mutual Fund for the last 15 years. His wealth of knowledge of product, research, central alliance segment, and combined with his previous experience at Axis Bank and Credence Analytics, he is uniquely equipped to guide us through the complex world of investment strategies. So let's buckle up and delve deep into the world of business cycles and investment strategies with Mr. Rajesh. So, welcome, Mr. Rajesh. Welcome to our podcast. In this podcast, we are going to learn about the intricacies of the business cycles with you. So, to start off, I would love for you to tell us what are business cycles and how do they, impact investment strategies.
So business cycles are basically that period of time when a particular set of business tends to be in favor. For instance, there was a period, maybe going back 5 years back, where themes like consumption looked much better because generally the overall outlook for growth in India globally was a little muted. And people were largely looking at themes like consumption, which are more, we could say, something which will happen every time as preferred option. But you can see how things have changed in the post-pandemic, post-COVID kind of era, which is the last 3, 4 years. Because growth is coming back not only in the world, but even more sharply when it comes to India and some of the other emerging markets. There is a big push from the policymakers to try and get the manufacturing as a very big theme in
Right.
India. So all that you could that kind of businesses which are more into manufacturing, which are more into global productions, exports, all these themes are back in terms of investor favor. So some of the more themes which are more of regular day-to-day kind of things, they are not in favor. This is
Okay.
something which keeps repeating at various points of time. So this is how business cycles usually play out.
Right. So we will have phases of high growth in the economy and slow growth in the economy. This is how the cyclical nature of
Right,
business will go on, right? Okay.
right.
And
Right.
you guys at Nippon take your decisions based on the business cycles, right? So how do you think that these business cycles impact your decision making?
So obviously it has very important when it comes because we are talking about active funds. So what I mean by active funds is funds where the allocations will keep changing depending upon the changing market situation. For example, few years back, as I said, our portfolio would have looked very different in terms of the thematic allocation to what it is today. So that is something which we are on lookout for. For example, if you think that next 5, 10 years, India could become a huge manufacturing possibility, given the dynamics in the global world today, where probably China is relatively lagging behind for various reasons. So all that can happen. Then, accordingly, the portfolio tilt will be more towards those kind of themes which can actually benefit from an opportunity like manufacturing, or it could be trying to benefit from the domestic demand, which can come in areas which hitherto are not so big in India, be it the travel industry, the hospitality industry, or even entertainment. So the portfolio tilt again would change. Probably a decade back, the portfolio would have been more heavy on some of the global themes, like for instance, technology, because that was a very big booming theme in India. India being a very large exporter of services in the IT space. So naturally, the portfolio tilt would have been more towards some of those themes. So this will keep changing with.
Yes. So that sounds a little bit like the concept of market timing, right? And how relevant is market timing based on business cycles to our portfolios?
So there are two different aspects here. So one is timing from an individual's perspective, and two, timing from a fund's positioning perspective. See, what happens is normally when we say there is a fund change or a fund's positioning, it is not done with a view from a very near term perspective. It is actually taken into account from a few years, if not 2 to 3 years. It could even be higher, 4 to 5 years kind of view. And the idea is to try and capture some of this potential opportunities. But from an individual's perspective, normally timing would mean that I get in now and I need a very quick buck to be made and then I'll exit. So that is very, very dangerous because what happens is a lot of our decisions are just not plain objective decisions, which is what mostly fund managers try and do in the underlying portfolios. When an individual like you and me, when we go and invest in the market, our judgment gets colored by our emotional bias.
Right.
Because all of us could have some kind of a legacy. A lot of us would start thinking that invest X rate. Today that value is down 30%, and you would think this is the right time to exit. Now I will take further losses. I will exit. So something similar we had seen with a lot of funds, a lot of market cycles, where fund managers held on with the conviction. Funds actually gave superlative returns, but investors did not get similar kind of returns. So that typically happens because of the emotional bias which comes in with our. So from an individual's point of view, from an investor's point of view, timing is something which should be largely avoided. And how can you beat this timing risk? Is by maintaining a very disciplined way of investing, understanding two aspects. One, what kind of risk appetite that we are ready to take, or how much loss can we take as an investor, as an individual, and what kind of time horizon. If we decide on these two things, then there is no real need for you to do the timing part, which can be very hazardous.
Right. No, so that makes a lot of sense. Individuals trying to time every short move in the market does not work in favor. But, fund managers looking at, a lot of data and, with a thorough analysis can time these business cycles, right?
Just one more small point, Sunam, on this part, which I need. At times we can be into wrong kind of thinking that fund managers do the same thing, which is consisting of multiple stocks. So usually that portfolio would vary between 40 to 50 stocks, or if not even higher at times. Also, the diversification is into multiple sectors. Whereas an individual, most cases would be fairly restricted in terms of how much they can invest. So even if you buy directly into some of the stocks, a few stocks, possibly most of them would come from a similar theme. So that diversification also is not there.
Right.
So a fund manager tries to hedge the bet, or kind of tries to de-risk the portfolio by having multiple themes, multiple stocks, which an individual may or may not be able to do.
Right. That makes a lot of sense, right? Now, talking about the different stages of the business cycle, right? So I would love for you to explain what are these different stages and, how can we as investors adjust our portfolio allocations in these different stages?
I think there are two aspects again here. Business cycle from a market perspective, overall economy perspective, what kind of cycle, what is it favoring? Second is the cycle for a particular set of business itself, for a particular company. Because each company would start the beginner, then graduate, and then go to a peak level, and then obviously start to stagnate, and then possibly move down or stabilize for some extent, and then possibly move down. So it depends on which cycle of business is that particular company in when you're investing in. The other mode is from a overall economy perspective. What is the economic visible? For example, because what is happening is India, we've seen a lot of reforms happening in India, because of which tax compliance or people paying tax, that number has gone up significantly. So that is one area. The second is the government's policy has been very supportive to encourage make in India, manufacturing, all these things. So if you put all these things together, what it tells you is government spend will be more towards encouraging more of economic growth rather than trying to give subsidies. That is one, because of the tax collections and all which they get. So the spend which they can do is that much more better. And then there are policy support which is there. So then the business cycle today is conducive to a particular set of business or businesses which you can try and benefit even with a set of portfolios. The easiest way out for any retail investor is to try and tap diversified equity funds. You don't have to sit and brood over what is likely to happen in the economy. That's something which an expert or a professional will be able to do that for us, which is the fund manager. The fund manager would study all these evolving macros, accordingly manage the portfolio. And as I said, the portfolio tilt will keep changing. For example, if it's heavy on banking and manufacturing today, if the cycle changes, tomorrow it could be IDAMA, which is probably years after that, it could be something else.
Yes, that
So
makes a lot
this
of sense.
rotation which keeps happening is element of the business cycle which is there.
Yes, yes. So I think what you're trying to say is that we can trust active fund manager to sort of take that call, right? Instead of as individuals trying to find that timing.
Yes, yes.
Perfect. But
because
just
the amount of information which are not.
okay, so I'll move on to the next question for you, Mr. Rajesh. I think even though we trust our fund managers to take these decisions, people are extremely curious, right? So they want to know which industry or sector might do well in any given business cycle. So if you were to comment on what specific sectors or industry you think will be suitable for different stages of the business cycle.
Really need to look at the broad macro numbers to understand which cycle we are currently in. So if you look at it, interest rates, which is there in the economy, is a very, very important indicator. And this is not something very technical to understand, because most of us today have EMIs running. correct? And we easily know when our EMI rate goes and up or goes down. So that's nothing but a play of the interest rates. So if the interest rate is more or less stable and it is not rising too much, it gives you a good indicator that probably the all those businesses, for example, like a capital expenditure or where you need money, where people borrow money and invest. For example, like what does a manufacturer do? What does a producer do? They try and use this money to build more capacities, correct? They create more manufacturing, more factories. So those kind of businesses will be a direct beneficiary of this. Indirect beneficiary will be typically a banking kind of system because banking is going to give them the funds. So naturally their business is going to go up. So which is nothing but we call as credit growth. So you can invest in those kind of business. Now look at the opposite side. Interest rate starts to rise significantly, which means some of these segments will face a financial impact. Hence, they will not be so much in fashion at that point of time. And you typically look at some of the other businesses which are more secular, which is something which you know, come what may. For example, when it comes to India, you know, consumption is going to happen. People still would require their daily dose of food, clothing, shelter, whatever. So the basic needs are anyways going to be there as part of any. So a fast-moving consumer goods kind of theme, a theme where people generally tend to consume more. For example, healthcare or pharmaceuticals. Those kind of themes which are more defensive, they're called defensive because typically when the economic growth cycle is not great, these kind of themes tend to do better or because people know that their demand is going to be more or less fixed, irrespective of what's happening in terms of the macros.
Right, right. So, and that's what we are seeing right now, right? That there's a resurgence of cyclical sector. There's a resurgence of these, strong themes as the interest rates are rising.
Yes.
Right?
Cyclical sectors normally would mean sectors which work well in their cycles which are favorable to them and possibly may also underperform when cycles are not in their favor. And then there are secular themes, for example, which I mentioned, healthcare and or typically these are more of themes which are expected to have reasonable demand across market cycles.
Right. So we talked about business cycles and how a fund manager sort of shapes his investment based on what they are expecting how they are expecting the economy to behave or a particular company to behave in a business cycle. But can we now talk about the benefits of systematic investment plans in this regard? How do LPs help investors during business cycles?
Sure. So SIPs is something which helps you avoid that timing bit of it. So when it comes to any kind of business cycle which we are looking at, what we don't know is whether what's the actually the correct time to invest or the correct time to withdraw. So both of them is always a thing which keeps going in your mind to make it more simpler. Typically, the worry for always us as an investor is whether I'm investing in a peak because once the cycle starts, the initial stage nobody would believe it. Only after the cycle sustains for some period of time, people or investors normally, lay investors would start looking at it more positively and they would want to participate. But by then, the run up would have already started to happen, and this would be there in whether I'm trying to get to this time or it's already peaked out. Probably the chances of from the point where I'm starting is that higher. So should I wait for the markets to correct or consolidate? And all this would be the normal thoughts which keeps coming in. So ideally, an SIP kind of investor would be able to tide over this because the investments happens at on a regular basis at various stages of this particular cycle. And usually what you see with cycles, again, there's no guarantee that this is how it is going to repeat all points of time. But usually when a cycle is set, it tends to carry out for at least a few years. So what happens is it's very difficult to get it at the right at the start. But the fact is if you're doing systematic investments, you will be able to capture the ups and downs because each cycle also will not be always a straight line. In fact, most of the times the cycle also will be up and down. Because even during a particular cycle which is favorable, the valuations can run up little ahead of fundamentals. There could be some consolidation. And again, new data points will emerge, basis which again you will be able to capture. So systematic investment plan helps you capture the cycle at different points of time without worrying really about the timing issues. So fundamentally, if you're convinced that this is a cycle which is going to be there for a reasonably long period of time, one should try and participate through SIPs. Also helps us to average out, as I said, the ups and downs. So very difficult to time the markets on both sides. So in case the market correction does happen, normal tendency for anybody would be not to wait and we will say let the correction get over and then I'll start investing. But how do we know what is the bottom and when the correction will stop? So one easy way to move out of that particular hassle or question mark which is there in front of us is to participate through the SIP route. So you can keep participating. So in case the value falls, in case the value of the investment falls, you accumulate more units. So if the NAV is down, you actually accumulate more units at that point of time. And in case the NAV goes up, even though you get less units on a value basis, it's still higher. So on both sides, you can still try and capture. So that is why an SIP is such an essential tool to capture any business cycle.
Yes. So I think, that answers our question that, talking from the perspective of business cycles, actually, help us in navigating that part. Now, if I were to ask you, Mr. Rajesh, that, if I'm an investor, planning for one particular investment goal, how can I determine the amount of investment that I should be doing regularly in an SIP, right? So what factors should I consider while deciding the SIP that I should be starting?
SIP to be effective for any SIP, and assuming mostly SIPs would be done in equity-oriented funds and done with a view of wealth creation at least from a medium to long-term perspective. So these are two essential rules because all of us have different set of goals. Some of them could be very short-term. For example, I might be planning to buy a new car, or I may be planning to buy a new house. I have already accumulated some money. I need to buy a car down the line. I'm just waiting for a new model and then possibly I will base my decision. And nobody would at the same time you're able to get some returns which are better than possibly some of the alternatives. But then you say no, I have 3 or 5 year where possibly I'm looking at a vacation 3 years down the line. Then you possibly would look at a particular set of fund to do investment. All this matters quite a bit as to how much you can set aside. So one is you decide what is your near-term goals, some emergency funds you need to keep. So move that aside. Whatever is left from the surplus or the excess income which you create, that is where you can plan for an SIP. Even within SIPs, it may not be that everything has to be done from a 10-year perspective. You can divide your goals, short-term goals, medium-term goals, and long-term goals. It may or may not be easy for you to decide, but at least broadly you can set a time frame for this. For a vacation, you can say 3 years down the line, I want to visit, I want to save from that perspective. That could be a short-term, medium-term kind of goal. Then you say, no, 10 years down the line, I need to give this money to some of my relatives. I need to create a wealth for them. That is one option. Or you say 20 years down the line, I need to save from that perspective. So your investment again will get varied in terms of the underlying options. We need to break this down. So this is something which an individual will have to do by themselves and understand their goals. We will not be perfect, but you can try to accurate as possible. Right. That helps us understand how to sort of structure our SIPs. Now, so as we just talk about, this term called rupee cost averaging that we hear a lot, right? And I think you talked a little bit about it when explaining SIPs. So can you talk a little bit about rupee cost averaging and how that can, save us from the impact of... Thing is nothing but trying market cycles, which you rightly mentioned, or business cycles, as we say, how it pans out. Because as I said, when it comes to any financial instrument, especially equity-oriented financial instrument, the movement is never linear. So you will see what I mean by that is the price of a fund, which is always have ups and downs, even during a cycle which is favorable. So for example, the fund at 10 can become 30 in a 3-year time period, which is fairly good returns. The fact is, during this period, it may not always move from 10 to 11, 11 to 12. It can happen that it moves from 10 to 15, 15 back to 13, again 16, then again back to 14, then 20. So that kind of thing, it will keep happening. For instance, there is one of our funds which is fairly very well known today in the market circles, especially for a lot of retail investors. So that fund at the beginning of the pandemic slipped by 50%. So what was 50 rupees became 25 rupees. So 50% fall between a span of 3 years, so or little less than 3 years. 2018, it had an NAV of 50. It moved on to 25 when the pandemic started, or beginning of March 2020. And from there, it is so it's become 4 times. So this is a cycle of a fund. I'm saying that fund obviously has been very successful from our investment, but the cycle has been like this from 50 to 25, 20. So this has been an up and down kind of journey. And this is what essentially what it does, it will put at various points of time. So nobody would know what is the lowest or what is the highest point. But if you start, say, investing something at 10, 10 becomes 11, fine. So at 10 rupees, say you put in 1,000 rupees, I think you get 100. And then if the 10 becomes 15, you get possibly 60, 70 units there, but if that 15 again comes back to, you are able to accumulate more units, the value is down. So this is what rupee cost averaging does, because the NAV movement is not linear. It's plus or minus at every point of time when you invest to get that additional benefit. So you accumulate more units if the value is continuous. So somebody argument says, what happens if I invest now and the market doesn't do well for the next 2 weeks? What happens is you buy at, say, and the next 2 years it doesn't come back to 20, it keeps going down. So from 20, it becomes 18, 18, 16, 14, 12, that kind of thing. Every time the number of units you accumulate for the same amount of investment, that keeps going higher. And when it starts to move up, you get that benefit because you have accumulated the higher number. So rupee cost averaging is nothing but it tries to average the ups and downs of a cycle of a fund, of a market, whatever you want to call it.
Right. So now, Mr. Rajesh, I think we've talked about SIPs, right? But I think it's a debatable topic. I think some people still, recommend going through the lump sum route as well, right? So would you talk about, when it is appropriate to go lump sum and what are the benefits of lump sum investing in different phases of the business cycle?
Wise, as I said, timing can be very ZS. So any kind of lump sum investor trying to time may not be the most appropriate thing. So the question is, is lump sum relevant, or should invest through lump sum? The answer is obviously it is quite relevant, because for an investor, for example, today I say you are an investor, and possibly you could spare 30 rupees every, and you don't need this money. You're just setting aside. You're saying I'm okay with saving for 20 years, correct? So for them, and you already say I have an accumulated corpus because I've not been investing for the last few years. I've been saving 30 rupees every year. Today I have a corpus of say a 500 or 1000 rupees with me already, which is ready to invest. So looking at your profile and the need, you would naturally feel that you should have an 100 rupees or 60 rupees should ideally. Since you have not already participated there, what you could do is you could do a catch up. You ideally should have invested, but since you have not invested, catch up happens via a lump sum. So you put a good part of it through lump sum because you already your profile says you should be 60% equity, 0% equity today. So you catch up with that with a higher equity allocation through lump sum. And then some portion of it which is more recurring in nature, you can make it as a, so if your asset allocation today, you're doing asset planning today, and you feel there is a gap that can be addressed with lump sum. And for regular recurring kind of investment, ideally go through SIP. So SIP also is nothing but it's just a form of investing, correct? So just differing your investments. So it is trying to match your cycle of liquidity or the cycle when you earn money or a salary, and trying to match that is what the SIP essentially does.
Right. So yeah, that helps us understand this a lot, right? Like lump sum is something that you can do, but don't try to time the market with your lump sum investments because
yes, it should be more from an allocation gap perspective.
Right. Right. So now I think we've covered the benefits of SIPs and as well as when is lump sum relevant. Now can we talk about the different risk and challenges that will come in the different parts of the business cycle that investors could be aware of?
Sure. Yeah. So what we need to take care is not to get sucked in by the narrative of the markets. So what I mean by that is there is always a narrative going on in the market, good or bad. So when things are bad, every other news flow which will come in, people will try to portray things are even worse than what it looks. Similarly, when things are good, people will again try to portray and extrapolate that. For example, you're growing at an X rate, people would say, no, that is not fine. You can actually grow at more than that. And they will say, suddenly the market has given you so much returns today, it can actually give you something plus plus plus, and hence you should keep investing. So both of them is something which we call it as noise. Try to avoid that. Try to have a discipline when it comes to invest. So the biggest risk is to lose track of the fundamentals or the actual what is possibilities, and focus more on this some kind of noise, because you will always have external noise, internal noise. What I mean by that is globally something will be happening, some geopolitical tension, some country going into war with the other, or some central bank they're increasing rates or decreasing rates. All this will have an impact in terms of the news flows. Similarly, domestically, it could be elections coming up, it could be some party in power, some policy change. All this will have. But if you're a long-term investor, and we have seen this over many years, a lot of geographies, even in India now, we have a 40 years market in India. And you've seen indexes like Sensex. So I'm not even talking about funds here, I'm just talking about plain index, which is available for us to track and see. We've seen that over a long period of time, if people remain invested on a, this is based on a rolling return analysis which has been done on Sensex and Nifty, that if you remain invested for a long period of time, especially beyond 5 years, the probability of losing money or getting negative returns actually becomes very low. The data point suggests that it's almost close to zero. But I think beyond 7 years, the probability of losing money is very, very low on one hand. Secondly, we've seen over this 40-year period, we have seen that index is given 15% plus compounded returns. What was 100 when it began? Today is 60,000 plus. So that tells you the possibilities. In fact, we have seen with one of our own funds, a journey of 10 rupees has become more than 2,000 rupees today over this last 25, 20, 26, 27 years. So this is what is the actual possibility of an asset class. But what happens is typically as an investor, we will get what is going on, we will get more distracted by the noise. And that is to me the biggest risk. The second thing is you get into a cycle with an expectation of based on past returns. For example,
Right.
2 years you're seeing a particular set of funds doing exceedingly well, and that has given you compounded returns of 30, 40% returns of maybe even 50, 60%, and you expect that will keep repeating even the year after when you invest, which may not always happen. So you started with a view that I'll invest for next 2 years, but you could end up getting disappointed because market cycles move fast, and at times if that happens, what happens is you feel disillusioned by what you are getting, and you might want to exit. So which is why you should
Right.
do your study, and
Mhm.
as long as you're investing, so the one way to avoid kind of funds which will easily delivering anyways the portfolio difference market cycles that will get aligned. Even at an individual level, we need to avoid getting into this. So as they say, market runs only on two emotions. It's either
Mhm.
greed of making more money or fear of losing money. So if you can
Right.
remain slightly balanced, it's not easy. Well, we understand
Yes.
it's not easy for any individual. If you can remain a little balanced and focus more on your goals. If I say I started with a goal of investing an X amount over a year, 15 year, 5 year, 20 year, whatever, I need to stick to that. There are
Right.
enough data points which is available to us, as I said, not only in India, but even with economies like US, which is 100-year plus, that if you can stick to your horizon and an appropriate mix of asset class, your experience will be much, much superior.
Right. So now, if you know, an individual were to ask you that what types of mutual funds should I invest into a given point of the business cycle? So let's say today, if somebody wants to start an SIP, what categories of mutual funds would you advise them?
It depends on the investor itself, because as I said, if the investor is a little bit aware on the markets, he's educated
Mhm.
and in terms of the market partners, and they're aware of the kind of risk, then there are multiple set of funds which they can choose from. So it could be a normal diversified equity fund for somebody who's a little new to this whole world of investing. Somebody who's more sophisticated. Then, as I said, today we believe a theme like a manufacturing in India can become large, or an infrastructure kind of space can become fairly large given all the support which is available. Somebody like a more informed investor can allocate some part of the portfolio. But ideally, the core part of the portfolio, what is core? Essentially, you could say two-thirds of your portfolio should always go to normal diversified equity funds. The idea being there the maneuverability is higher. The fund manager can take the decision for you. Individually, all of us have the time and the understanding the possibility, but since we don't have that at our disposal at all points of time, this
Mhm.
is much easier to participate in this, and some or innovation. All this could be very interesting kind of themes which somebody can look at. But you can get a play of this anyways through diversified.
Right. So now to wrap up, Mr. Rajesh, I would ask for a final piece of advice that you would give to any investors who's looking to do a investment right now, either through SIP, lump sum, and how they can best navigate the business cycles.
Basically, what people have seen, at least from a last few years point of view, last 2, 3 years, Indian equity markets have delivered reasonably strong returns. So there's always a tendency to look at the past returns, even though we would urge people not to really get too much weight, both high or low returns, because both of them may not necessarily repeat going forward. And somebody who sticks around for a reasonably long period of time, look at the broad macro. See, today, before even you look at markets, funds, and all, just look at the environment which is happening around us. We've been obviously seeing a faster growth, a lot of areas which probably India was not so strong a few years back. Today is more visible to us. So today, when we walk down the line, we can see huge activities in areas of railways, in terms of roads, and a huge push in a lot of other areas, which will give us that thought and confidence as to where and how the investment should pan out. And then you come to the investment conditions. So our suggestion obviously would be here that you first of all look at your own risk appetite, understand what kind of risk you can take. Just answer some simple questions like, would you be comfortable with taking a 20% loss with the view that from a longer term perspective you will still get possibly superior inflation adjusted returns? If you're okay with that, then obviously equity is something which you can look at. You're just starting in equities, probably you should look at more diversified funds, maybe large cap oriented funds to start hybrid kind of funds which are a mix of debt plus equity or equity plus debt. So that kind of funds to start off with. As you graduate, possibly get into more of flexi cap kind of funds which give you a good participation in different market segments. How should you invest? As I said, if you already have put in a corpus today, you have a corpus with you to invest, and you are lagging behind because you didn't invest at some point of time, do a combination of lumps plus SIP. But systematic investment is something which is more advisable. You get a regular kind of income and you want to participate regularly. And it also saves you the hassle of worrying too much about market conditions to determine whether you should invest or not. It becomes an automatic kind of solution available to you So SIPs, STPs, there are multiple options under systematic which one can
Right.
use and participate.
Right. So I think this was extremely insightful, Mr. Rajesh. I think people learned a lot about business cycles, systematic investment plans, and how they can, sort of navigate this complex journey in the financial market with the help of experts like you. So thanks a lot for coming on our podcast, and I hope that we'll see you again and more people from Nippon India talking to us. Thanks a lot for this discussion.
Thank you. Bye.
Thank you, Sonam.
So that brings an end to our insightful conversation with Mr. Rajesh. We covered everything from the intricacies of the business cycles to benefits of SIPs to how to navigate the volatile financial markets. Our hope is that you found this discussion illuminating like I did. And these tools will equip you to make better investment decisions in the future. A special thanks to Mr. Rajesh for joining us today and sharing his deep insights and his valuable advice. If you enjoyed this podcast, please do like, share, and subscribe to our channel and keep coming back to us for more such insightful content on financial investment. I'm your host, Sonam Srivastava, and this was my conversation with Mr. Rajesh Jayaraman of Nippon India Asset Management. And until next time, stay curious, stay informed, and happy investing.